Hello and welcome to Module 3 of the Series 65 and 66 series from Series 7 Specialist. We hope that you enjoyed the first couple of modules as much as you can on this material. I know that it's really boring, but that's what we're stuck with, and it's you can see that it's going to be a tough test. But in any event, if you wouldn't mind doing us a favor, just go up on series7specialist.com. We've got a contact us page, and just send us a comment or something, or better yet, make a comment there on YouTube, subscribe to our channel. All of those things really help us out as we try to get this established and to make this service a reality where we can actually provide the full classes for the different licensing tests that are coming up. So again, your comments, your likes, your subscriptions, those all mean something to us, and we really appreciate you taking the extra time and effort to do that. So in any event, let's go ahead. We've gone through the Securities Act of 33. Remember, we renamed it. We called it the Securities Themselves Act of 33. The primary year, the primary market is what was covered there. Now that we have those securities, that paper out into the marketplace, now let's look at the way that we trade those securities around. So let's look at let's rename this one, Securities, Exchange thereof. Act of 1934. We've referred to the fact that 34, the secondary year, if you want to call it that, and the secondary market activities are what we're going to be dealing with. So the Securities Exchange Act of 34 attempt to control and eliminate market manipulation. Now, you may see some questions on the test that which of these will manipulate the market. Remember that there are a lot of prohibited practices which do not manipulate the market. All right, so if I fail to tell you all of the material facts surrounding a certain security or trade, what have you, that may be a prohibited practice, but it's not manipulating the market. So for market manipulation, look at the bigger picture. What's going to create the image of something that's not there for folks who are not in the know? All right, so like for instance, one of the things is to create excessive volume. These days, that's not that big a deal. To make some of this stuff make sense, what you have to do is to time warp yourself back to 1934 when maybe you had 50, 100,000 shares traded on the whole New York Stock Exchange in a day. All right, I would have to look it up, but it's by no means the millions of shares that we have. In fact, it was the 1980s before we got to 100 million shares that were traded. Now we do that in the first, 42 seconds or less. So anyway, but a lot of these things, think back to where we had no technology, we had very, very low trading, and a lot of those things will make sense. So churning or excessive trading is prohibited also. Churning is basically increasing the YTB, that's yield to broker, at the expense of the customer. Yes, there are customers who will be active traders, who will want to trade every day. It's suitable, it's right within what they want to do with their objectives, their means, that's fine. Activity and churning are two different things. Churning is activity, yes, but it's for the purpose of increasing the return to the broker. So in order to tell the difference between the two, you have to consider all those factors: the customer resources, their objectives, the character of the account, and by that, if we have a retirement account, you're going to have typically lower trading activity in a retirement account than you do in an account that's set up for option trading. And excessive size or frequency of trades, either one of those can be considered to be churning. So if, for instance, I do with someone who really wants, needs, and likes municipal bonds, 13 trades a week, that's a whole lot of trading, for somebody who is a municipal bond buyer. But on the other hand, if I have someone who has $100,000, and I typically put on positions of $70,000 to $90,000 in one stock, that's creating a concentration, so that's excessive size. Perhaps putting someone on margin, where margin is not suitable, so that you can get that larger ticket, that could be considered to be churning. Wash sales or trading pools are prohibited as well because they are manipulative. They manipulate the market. And so what they do is to create the false appearance of activity when there is none. Again, with all the volume that we have today, you would have to have a huge pool, trading pool, to actually pull this off. The test doesn't consider that. You need to know that if you and I and 4 other folks set up a trading pool, and I buy something, then sell it to you, you sell it to Bob, Bob sells it to Mary, Mary to Ted, Ted to me, I sell it to you, you get the idea. That's going to be market manipulation. And just assume that that type of activity would show up as excessive volume where there really was none. At the end of the day, we still own the same 500 shares that we did at the start of the day. We've just created that activity, or the appearance of that activity, by having a trading pool. Matched orders, again, where I buy and you sell, then you sell and I buy. We just buy and sell from each other. Pegging a price to a certain level, okay, keeping it from moving up or down off of that level. Price fixing, we have a target of here, so let's just put in buy orders until we get it to here, okay. Capping, stabilizing, capping, not letting it go any further up than that, stabilizing, not letting it go further down than that. There's one case where stabilization is permitted, and that's on a new issue where the underwriters can keep it from just entering into a free fall. Probably won't see that on this test though. So stabilizing is going to be a prohibited activity. Those are all manipulative. All right, the 34 Act also addressed transactions by insiders. It also gave us a technical definition of who an insider is. Technically speaking, an insider is an officer, director, or 10% shareholder in a company. Now, the courts and later on Congress has expanded that to where anyone who's in contact with, in possession of, material, non-public information is considered to be an insider. All right, but we'll cover that a little bit later on. For now, we're looking at insider transactions. Insider transactions are legitimate because the officer, his kids go to college too. It's just as expensive for his kids to go to college as it is for your kids to go to college, mine. And so we may have to sell some stock. What's the natural thing for us to do? Sell a little bit of our stock that we have in our company where we're an officer. That's okay. It's just that you can't do anything in secret if you're an officer, director, 10% shareholder, or spouse thereof, okay? So in fact, really, if they're acting in concert with these people, they're considered to be the people, typically, under these rules. So insider transactions have to be reported to the SEC within 2 days of the trade date. It's fine if you do something, just let us know what you do. Paperwork, yes, etc., but be sure to report it within 2 days of the trade. And then also, what happens when you become an insider, or you're on your way to becoming an insider? When you get a 5% or greater stake in a company, let the world know what you're doing. And so you file a 13D filing. Okay? If you're an active investor, you'll report it to the marketplace, to the issuer, to the SEC, and Form 13D is typically what if you have to default to a letter, default to the D. That's fine. All right. So the 13D is the more generic. I got to file a 13D filing. Whether I'm an active investor or not active, what I'm doing, I'm wanting to take an active role in the management of the company. Perhaps get a seat on the board. The way that I keep these separate is that on your way to taking over the company, you've got to cross over that 5% threshold, and to the existing board of directors and officers, they may consider you to be the devil. So the 13 devil filing if you're an active investor. On the other hand, if you are a fund or a foundation, then you're much more friendly, because what are you going to do? You're going to call up the officers, you're the CEO, and you're going to say, look, we're going to pick up a 7% stake in your company. Really? Hey, that's great. What are you thinking? Say, well, we like the business, we like the dividend path that you're taking. we just think it's going to be a good long-term investment. So, we'll come to the annual meetings. We'll maybe play a round of golf. Sure. Hey, that's great. And as it stands right now, just keep doing what you're doing, and we'll probably hold this thing for 5 years, 10 years. Man, there's what 6-7% of the float that's gone. So that's a good deal. So a 13F filing, if you're friendly, if you're a fund, all right, that's what you'd file. Institutional equity managers file those. They have discretion over 100 million more in equity assets. And like I say, it's a fund, a foundation, something like that. Less stringent reporting and update requirements than if you're the devil and you plan to take an active role in the management of the company. Now, insider transactions, cool, that's fine. Those are legitimate. Insider trading, no. There's a prohibition against that because that is acting on material, non-public information. Material, it can reasonably expected either to influence someone's decision to buy or sell the stock, or if known, it would move the price of the stock. Non-public, it has not been reported to the news media just yet. Once it's reported, it's considered to be public information. Now, an insider definition, again, it's officer, director, 10% shareholder, but ITSFEA, insider trading, and I don't even remember what it stands for. IT is insider trading. If you remember that, you're going to be in great shape, okay? But the 88 Amendment to the 34 Act expanded that out and said that anyone in possession of that material non-public information is considered to be an insider. It's not against the law to have insider information. In fact, you have to have material non-public information to do business. There will be a point where you'll have to do that. So what do people do when they come into possession of this? Well, it depends. Who is the person? Is the person you, or is the person anyone else in the world? If it's anyone else in the world, then basically you zip it, you lock it, you throw away the key. That's it. All right? Because if you act on it, if you share it, if you tell someone else, you're in violation of the law. What you will need to do is to tell your supervisor. Then zip it, lock it, throw away the key. Because the reason you do that is because your supervisor now is in a position to where he or she knows that there's a potential hazard for a violation of the law. And therefore, they should be on the alert to supervise you more closely. I've had the question asked, what would happen if my supervisor then used that material non-public information to buy or sell themselves? Well, you would be the key witness for the prosecution in their insider trading trial. Okay, you do the right thing. You let the principal or let your supervisor worry about themselves doing the right thing. All right, you do what's right. You tell your supervisor, open up your books, say just supervise me, watch me more closely, because there's danger here. So, like I say, sharing the information is bad as trading. The criminal penalties up to $5 million and up to 20 years in prison, so they're very serious about it. Then civil penalties are also associated with this. Disgorgement of the ill-gotten gains. Basically, I've got to give up what it is that I made, or it could be that it's bad news, and I think that thing is going to go down. Well, in that case, if I sell here, I have avoided a loss of that much. The avoidance of a loss is just the same as the creation of a profit if you're doing it with material non-public information. And that's one thing that you can actually kind of take generic about all of these rules, is that if it says this, it's kind of like a building where the front door is locked. And there's a sign on it that says, no trespassing. And so you go around and you say, oh, well, the back door's open. We can go in. No, you can't circumvent the law. You can't get to a point where you say, well, yeah, but. No, if you do it backwards and kind of back into the thing, it's just as bad as just going straight forward, like in through the front door. All right. So in any event, avoidance of a loss, like I say, is just as bad as the creation of a profit. Plus then treble damages, or 3 times that dollar amount in damages. Then you also have a line there as private rights of action by contemporaneous traders. Now let's set up a situation here where I used material non-public information to buy a stock that I knew was going to have some great news, all right, and I knew that it was going to push the price 5 times, all right. Doesn't matter. It's going to move it up. It doesn't matter the degree, the magnitude. All it matters is it's going to move it up. Now you are a shareholder in that stock right now. So I buy the stock. I've got to buy it from somebody. Did I buy it from you? Well, I don't know. We could go back and look at time and sales, what have you. But basically what this concept is that if I buy it in this period in through here, and you sold it in this period pretty much the same, then I damaged you. Because if you had had the same information I had had, you would not have sold. You would have at least held, if not bought more. And so therefore you are a contemporaneous trader. And so having damaged you, you have the right to bring a civil action against me. So that's what that refers to. Basically just opening it up to make the other side of the trade right. Now firms, broker-dealer firms, man, I tell you, there's a loading dock that's marked inside information, and big trucks back up and they use the forklift to pull up. You got to. This is what they do, is they do deals. And so brokerage firms have to have written policies to address what they're going to do with insider information, how they're going to treat it, what safeguards will be in place, and a Chinese wall. That is one of the terms that you'll need to be familiar with. Basically, what you do is that the investment banking group, they're going to be the ones that get that inside information, typically. All right, from time to time it'll be an individual, doesn't really matter. Wherever that inside information lands, you build a wall around it. You use it for legitimate business purposes inside that wall. But these guys in investment banking can't tell the retail brokers. They can't tell the analysts. They can't tell you. If you get it, who do you tell? You tell your supervisor so they can supervise your books more closely. Do you tell the trading desk? No. Do you tell the research staff? Do they supervise you? No. So if they do, yes, you tell your supervisor in the research department, but you'll not see that situation on the test. They tell your immediate supervisor, that's it. To tell anybody else in the company is going to be a violation of not only the base insider trading law, but also the Chinese wall doctrine. So like I said, just keep it to yourself. That's basically it. The information can be used for the benefit of the corporate customer only. Like I say, that investment banking group, they have a deal to do. And so they need to use that information, but it's to benefit the customer. Next thing about the 34 Act is that it created the Securities and Exchange Commission. Now, that's kind of interesting, okay? The 33 Act required that new issues that were non-exempt coming to market in a non-exempt transaction, remember the little hopper there, that they register with the SEC. But then the SEC wasn't even created until the 34 Act. What'd you do in the meantime? Okay? It doesn't really matter. The thing is, the 34 Act is the one that allowed for the creation of the SEC. The structure of the SEC is very important because it shows up on the test. In fact, one of the things I do is I put a star out here on my outline in the margin because this is a layup question or two. Sometimes we'll see a couple of questions. You've got 5 appointees to the commission. Okay? And it's just like any other appointment, except that this one doesn't get the big press like the Secretary of the Treasury does, or a Secretary of Defense, all right? It's a presidential appointment, advice and consent of the Senate. They'll hold the hearings, the whole 9 yards. It's just a normal procedure. But then you have staggered 5-year terms, so somebody's rolling on and somebody's rolling off every year, and it's required to be bipartisan. Do the math. If you've got 5 members and you can have a maximum of 3 from one party, then you're always going to have Democratic presidents appointing Republican commissioners and vice versa. You just got to do it. So it's got to be bipartisan. It is a full-time position. You resign your old job, You put stuff you have into a blind trust. Yeah, you don't. 5 years from now, you'll figure out how well the guy did. Okay, maybe you can get I don't even know if you can get a bottom line number, but basically, you've got to isolate yourself to the greatest degree possible from every business contact that you have, so that you can focus on what's good for the investment community, what's the fairest to investors. All right, so that's the structure of the SEC. Lots of, like I said, lots of times you'll have questions on that particular piece of information. So let's go ahead and talk about one more, then we'll take a break because we're about at our 20 minutes. It gave regulation over margin accounts to the Federal Reserve Board, the 34 Act did. And then you've got Regulation T. That's how the Federal Reserve Board responded. So they're all kind of blended. It's like dominoes. Okay, 34 Act gave it to the Federal Reserve Board. Federal Reserve Board responded with Reg T. And that the purpose of that was to curb excessive speculation. It also said that there's no credit on new issues for 30 days. And I mean, you've seen, especially if you remember back in the dot-com heyday, how these things were just going wild. Can you imagine? Everything's exponential. You would have had 4 times the amount of excessive speculation if people could have bought those new dot-coms on margin. And the full payment on COD or delivery versus pay DVP orders has to be within 30 to 35 days. Now COD DVPs, those are going to be for institutional purchases, and like we said in the last one, with institutions, you just don't have the propensity to go around and find that back door that's open. Institutions have, they're straight up, so you can give that extra 35 days. All right, and it is a 35-day max. So like I say, we'll call this a breaking point. We'll go ahead and take a break. We'll come back in a few minutes and pick up then where we left off. So in any event, glad to have you with us.